Hello friends. If you were born before 1960, Centrelink has quietly changed 4 things about your age pension this year. And going by the calls flooding into Services Australia right now, most pensioners haven't been told any of it. One of those changes is already shrinking part pensions for people who did absolutely nothing wrong. Another one has pushed thousands of Aussies who were told you don't qualify back into eligibility, and they don't even know it. There's a card sitting in a lot of wallets right now charging more for medicine than it should be. And there's a rule about gifting money to your kids that, if you get it wrong, can freeze part of your pension for years. None of these are rumours. They're sitting on the Services Australia website right now in the fine print nobody reads. By the end of this video, you'll know exactly which of these 4 things apply to you and what to do about each one. Grab a pen if you need to. Some of these numbers are worth writing down. Before we get into it, hit subscribe and turn the bell on. And here's the honest reason why that matters. Age pension rates, the assets test, the income test, and deeming rates are indexed twice a year, in March and September. Centrelink doesn't ring you up when your threshold moves. They just update the system, and if your circumstances happen to cross a line, your payment changes, sometimes without a letter that actually explains why. The people who follow this channel find out before the next indexation date. Everyone else tends to find out when their payment lands short and they're left ringing 132-300 trying to figure out what happened. Subscribe now so you're not in that second group. Before we continue, if you find these updates helpful, please subscribe, like this video, and leave a comment below. It really helps us continue bringing you important updates. Let's start with the one affecting the most people, because if you've got any savings, shares, term deposits, or superannuation outside your pension and you're on a part age pension, this one is about you. Here's what most retirees don't realise. Centrelink doesn't look at what your bank account or your super actually earns. Instead, they assume a set rate of return no matter what you're really getting. That's called deeming. For years, that assumed rate was frozen low at 0.75% and 2.75%. For a single person, the lower rate applies to your first $66,800 of financial assets. Anything above that is deemed at the higher rate. For a couple, that threshold is $110,600 combined. Why does this matter? Because a higher deemed rate means Centrelink assumes you're earning more income from your savings than you might actually be, and that assumed income counts against you in the pension income test. If your total assessed income creeps over the free area, $218 a fortnight for a single person, $380 combined for a couple, your pension gets trimmed by 50 cents for every dollar over for singles or 25 cents each for a couple. Picture someone with $150,000 in savings and term deposits. Before the change, their assumed income under deeming was lower. After 20 March, Centrelink now calculates their deemed income at roughly $3,591 a year, about $138 a fortnight, up from what it would have been under the old rates. If that pushes them past the free area, their fortnightly payment quietly drops, even though not a single dollar of their actual bank balance moved. The fix isn't to panic, it's to check. If your pension has felt smaller these last couple of pay cycles and you weren't sure why, this is very likely the reason. Log into your MyGov account, check your Centrelink income statement, and see what your current deemed income is listed as. If something looks off, that's worth a call to the Older Australians line. Now, here's the flip side, and this is the one costing people money not because their payment dropped, but because they've never claimed anything at all. Alongside the deeming changes, the assets test cutoff limits were also indexed on 20 March 2026. A single homeowner can now hold assessable assets, this excludes the value of your own home, up to roughly $322,000 and still receive at least a part pension. That ceiling moves every March and September, which means people who were knocked back a year or two ago because they were just over the limit may now be sitting
comfortably under it without lifting a finger.
There's a real example worth mentioning here. A single homeowner with assessable assets around $715,000 was told she didn't qualify because the old cutoff sat right at that figure. When the threshold was indexed upward in March, her same assets, she hadn't spent a cent, fell just under the new limit, and she picked up a small part pension. On its own, that might only be worth $60 or so a fortnight, but the moment you're approved for even a token part pension, you're automatically issued a pensioner concession card, which opens the door to cheaper prescriptions, discounted utilities, and reduced council rates in most states. Retirement industry data suggests roughly 1 in 3 people who bother to check their eligibility again end up qualifying, and most of them weren't getting anything from Centrelink beforehand. If the last time you checked was more than a year ago and you were told no back then, it is genuinely worth checking again. Thresholds move. Your no from 2024 might be a yes today. If you're one of the many pensioners who've kept a part-time or casual job, plenty of people do, whether it's for the extra cash or just to stay active, this next part is for you. Most people assume any dollar you earn while on the pension gets clawed back straight away. That's not quite right. Under the work bonus, you can earn up to $300 a fortnight from employment before it counts against your pension income test at all. And here's the part almost nobody uses. If you don't work one fortnight, that unused $300 doesn't disappear. It banks up in what Centrelink calls your income bank, up to a total of $11,800. Think about what that means practically. If you take on seasonal or casual work, say retail over the Christmas period, or a few weeks helping out at harvest time, and you've been building up your income bank all year by not working, you could earn a genuinely large lump sum in a short burst without it touching your pension at all. Most retirees who work casually have no idea this balance exists, and they let it sit unused, thinking every dollar earned is a dollar lost. It isn't. Check your income bank balance on your Centrelink online account before you assume working more will cost you your payment. This one's for the self-funded retirees, or anyone whose income sits just above the pension cutoff point. If you hold a Commonwealth Seniors Health Card, or you've never applied for one because you assumed you earned too much, listen closely. The CSHC isn't means tested on assets at all, only on income, and the income thresholds were broadened significantly in a 2022 reform, then indexed again as cost of living adjustments resumed. If your income is under roughly $90,000 as a single person, or $144,000 combined as a couple, you may be eligible even if you're nowhere near qualifying for the actual age pension. This card gets you cheaper PBS medicines, bulk billing incentives for some GPs, and in most states, help with power and gas bills. Here's the trap. This card is assessed on income, and deemed income from your super and investments counts towards that test, the same deeming rates we just talked about. If your account-based pension or super balance is large, the March 2026 deeming increase may have pushed your assessed income up, even though your real income hasn't changed. For someone with a $300,000 account-based pension that started after January 2015, deemed income under the new rates comes out to roughly $8,500 a year, up from about $7,000 under the old rates, an increase of about $1,500 purely from Centrelink's assumption, not from anything you actually earned. If you're a CSHC holder sitting close to that income line, that shift alone could be the difference between keeping the card and losing it. Check now. Don't wait for a renewal letter to tell you. 2 smaller but genuinely costly issues to close on. First, if you've lost a partner and you're now on your own age pension, has anyone at Centrelink actually sat down and confirmed you're on the right rate?
Single pensioners receive a higher rate than the each rate paid to a couple because Centrelink recognizes that living alone costs more per person than sharing a household. If your payment was never manually reassessed after your circumstances changed, it's worth a direct call to confirm you're being paid the correct single rate and that any rent assistance or supplements have been updated to reflect your new situation.
Second, the gifting rule. A lot of retirees want to help their kids or grandkids financially, maybe with a deposit for a first home. Centrelink allows you to gift up to $10,000 in a single financial year or $30,000 over a rolling 5-year period before it affects your pension. Go over that limit and the excess isn't just noted, it's treated as if you still own that money for the next 5 years and it gets counted in your assets and income tests the whole time, even though it's long gone from your bank account. Every year, pensioners hand over a lump sum to help family without realizing this rule exists and then can't understand why their payment dropped and stayed dropped for years afterwards. If you're planning any gift over $10,000, it is genuinely worth spreading it across financial years or getting advice first. Here's everything in one place. Deeming rates rose to 1.25% and 3.25% from 20 March 2026. Check if that's quietly shrunk your part pension. Assets test thresholds also moved up, so if you were rejected before, it's worth checking again. The work bonus lets you bank up to $11,800 in unused fortnightly allowance for tax-free to the pension casual earnings. The Commonwealth Seniors Health Card income thresholds sit around $90,000 single and $144,000 combined, but deemed income from your investments counts toward that test too. Widows and widowers should confirm they're on the correct single rate. And any gift over $10,000 a year or $30,000 over 5 years gets counted against you for half a decade. None of this is complicated once someone lays it out. The problem is Centrelink doesn't lay it out for you. They wait for you to ask. If this helped, do 2 things. Hit subscribe so you catch the September indexation changes the moment they land, and send this to someone you know who's on the pension or getting close to it. Chances are at least one of these 5 things applies to them too.